Hey everyone, welcome back to Corporate Decoder. Today, StablecoinX Incorporated just filed its Q2 2026 10Q report, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company posted a massive loss, but also a huge chunk of a cryptocurrency that is causing a lot of confusion. Let's dive straight into the numbers. StablecoinX Inc. reported a net loss of about $34.2 million for the 3 months ending the 30th of June 2026, and a slightly larger loss of around $34.6 million for the first 6 months of the year. This is a pretty big number for a company that is just starting to get going after its business combination. Looking at their balance sheet, their total assets jumped from about $683,000 at the end of 2025 to over $232 million by the 30th of June 2026. That is a massive increase, mainly driven by something called digital intangible assets, which grew from nothing to over $212 million. Now here is where it gets interesting and a bit concerning. They recorded an impairment of digital intangible assets of a whopping $36.2 million. This means they had to write down the value of some digital assets they hold, suggesting they're worth much less than they thought. This happened in both the 3-month and 6-month periods of 2026, showing a significant drop in the value of these assets. This digital intangible asset is mainly their holdings of Ethena tokens. The company received a huge amount of these tokens as part of its business combination and private investments. These Ethena tokens are tied to the Ethena ecosystem, and their value has been pretty wild. The filing states that these Ethena tokens are outside the scope of a new accounting rule, meaning they are treated as intangible assets, and their value is tested for impairment. This is why they had to take that big hit on their books. This massive loss translates directly to the earnings per S.T.A.B.L.E.C.O.I.N.X. For the 3 months ending the 30th of June 2026, their net loss per S.T.A.B.L.E.C.O.I.N.X was about negative $15.27. And for the 6 months, it was even worse at negative $23.50 per S.T.A.B.L.E.C.O.I.N.X. This shows how much they're losing for every share of stock out there. On the revenue side, things are very small. They reported just over $62,000 in revenue for the 3 months ending the 30th of June 2026, and about $63,000 for the first 6 months. This revenue comes from Validator services and DVN services, which are basically fees for helping validate blockchain transactions and verify cross-chain data. This is a tiny amount compared to their expenses and losses. They also have significant liabilities. They took on about $6.9 million in convertible demand notes payable from former sponsors. These notes were in default and the company had to assume the liability. This is a serious financial obligation. Then there is a warrant liability of $4.7 million. Warrants are like options that give holders the right to buy stock at a certain price. The company has to account for these as liabilities and adjust their value each reporting period, which can cause big swings in their reported earnings. The notes section details this digital intangible asset further. It is primarily Ethena tokens that they received as part of their business combination. The company received over 284 million Ethena tokens from Ethena and another massive amount from PIPE investors, totaling hundreds of millions of tokens. The value of these tokens on the 25th of June 2026 was over $23 million from Ethena and over $115 million from the initial PIPE investors, plus another $110 million from additional PIPE investors. This is a huge concentration of value in one digital asset. Their DVN services revenue comes from a deal with S.T.A.B.L.E.C.O.I.N.X. They get paid a fee based on transaction volume, but that fee is paid in Ethena tokens. This means their revenue generation is directly tied to the price and demand for Ethena. Now, let's look at the risks. The company acknowledges its heavy reliance on the Ethena ecosystem. If Ethena or its products like USDEW run into trouble, it could hurt StablecoinX across all its business lines. They also mention the extreme volatility of Ethena and how that can impact their treasury and revenue. They admit they might not be able to successfully execute their strategy. Their different business lines like infrastructure services, software, and distribution services are at various stages, and there is no guarantee they will all succeed or even contribute to revenue. Cybersecurity is a major concern as it is for any company dealing with digital assets. A breach could lead to significant losses and damage their reputation. Their Ethena holdings are a double-edged sword. While strategically important, they are also a major risk. The value of Ethena is volatile, and if it drops significantly, it hits their balance sheet hard. Plus, receiving fees in Ethena means they might not always have the cash they need readily available. The regulatory landscape for crypto is always changing. New rules or stricter enforcement could really impact how they operate, their compliance costs, and their overall business model. They also face fierce competition. Other companies have more resources, longer track records, and might just be better at what they do. This means StablecoinX might struggle to gain market share or keep its margins healthy. Looking at this report, StablecoinX Inc. is a company in a very high risk, high reward situation. They've got a massive amount of Ethena tokens that have seen a big impairment, huge losses, and very little revenue from their actual services. Their whole strategy seems tied to the success of the Ethena ecosystem, which is a big bet. The fact that they had to write down the value of their digital assets by over $36 million in just 6 months is a major red flag. The biggest risk I'm watching is how much their strategy depends on the success of Ethena and the Ethena ecosystem. If Ethna's price continues to be volatile, or if Ethena faces regulatory hurdles, stablecoin could be in serious trouble. My biggest concern is the large impairment of their digital assets, indicating a significant loss of value in a very short period. What I'm actually looking for is a clear path to profitability that doesn't solely rely on the price of Ethna. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Alright, that is my tape. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.